full deck today. We're excited to take you through the 2023 recap and some of the things to be on the lookout for as we get into here 2024. Again, thanks for putting aside the shovels for those of you in the Northeast. I know I've got some folks from Maine and Vermont on the call today, and some folks in more warm climates, right? The California crowd, thanks again for getting up this morning early. And I want to call out again the Michigan fans. We got a number of Michigan alumni. Your 2024 is off to a great start as the Wolverines won the national championship. First time that's happened since I was an undergrad a long time ago. So we're going to kick off again. It'll be just Tom and I today. There'll be a lot more speaking from the two of us. We're the better looking of the crowd, so on that front you win. But again, the brains organization, she's off for the day, but she is doing well. I spoke with her yesterday. Things are going well on the home front as she finds some sleep here and there. Just again, quick kind of updates on Breakwater. We're about a year and a half in at this point. 2022 is when we found it. It's the three of us taking care of now what is closer to about 200 families in 26 states. And as a fiduciary, we're just really wonderfully grateful to have the opportunity to take care of you and do what's in your best interest. And again, just thanks for giving us the time this morning. The sources for the content, we primarily leaned on Charles Schwab and JP Morgan, but there are a host of others. Some of the content is stuff we can share if you're interested. Others, we have to just kind of maintain their intellectual property requirements. So again, happy to talk through that stuff. The meeting will be recorded. We'll push that out probably at some point towards the end of this week, early next week. So let's dive in. So 2023 was an interesting year, right? We had a great start. I remember reading articles, hey, the best start since 1998. Only hit an air pocket with a banking crisis. Fortunately, nothing quite nearly like we saw about 15 years ago. And then we found some footing into the summer before the market got a little bit ahead of itself, specifically around interest rates. And it seemed quite clear, evident that, growth would actually be better than forecast. And so from, really late July through October, we had a bit of a correction, right? A lot of that was a massive move in interest rates. We'll spend some more time with that in a minute. And then we're given a gift, or maybe a better way of describing this is instead of getting a trick, we got a treat around Halloween time. The market started a pretty nice rally and pretty much ended the year up with the last 9 weeks. Backdrop of that is strong labor markets, or unemployment rates at 3.7%. Continue to see some progress there, and wages are now actually north of inflation, which suggests that the capacity for investors, or individuals to save, spend, invest versus just kind of feeling like they're spinning their wheels at work. The interesting development, or perhaps what could be a positive development here, is maybe some improvement on the housing front. As we get into spring selling season, mortgage rates have come back down. They're still quite high in relation to the last 5 years, but historically back to kind of where they've been the long run average. Again, a really good year for the S&P, up 26%. You might think that volatility would have been a little bit elevated, especially given a couple of those bouts of noise throughout the year. But throughout all of 2023, we really saw a pretty quiet year for volatility in the market, the equity market, not so much the bond market. We'll talk about that as well. And probably one of the positive developments, aside from the Fed's pivot, which again took place in October, was just the return to earnings growth. We've been pretty much in an earnings recession for 3 straight quarters of declines. And as earnings should ramp up or accelerate more in 2024, that's a positive. Again, that's been somewhat reflected already in stock prices. When we think about GDP in the U.S., again, it's the big engine that could, as I've talked about, reading the little engine that could to my little guy from time to time. And so, again, the U.S. continues to propel the global economy forward. We're growing around 5% plus in the third quarter. Fourth quarter is decelerated. We'll probably get a final read on that in the next couple of weeks, but 2+% is still a decent level, given that's in real terms, given just some of the dynamics of our economy. We had some drama continue with respect to U.S. politics, right? As the Speaker of the House is changing the guard, and we'll see what happens in the coming weeks as we deal with a spending bill that should hopefully at least buy us some time until later in the year before we start this whole thing all over again. We obviously had some tragic events, right? The war in Ukraine continues, the terrorist attacks in Israel, coupled with what's been a 100-day land war, and then Charlie Munger, and among others, passed away in the fourth quarter. Lastly, again, not necessarily something I wanted to include in here, but you have to acknowledge it. Crypto is back, right? We just saw a approval from the SEC of Bitcoin spot ETFs, and again, I'm not convinced there's money value there, but again, acknowledging that some folks who are on the call today do in fact, participate in those markets. So let's get in the economic update, just to get really more into the weeds here. And because there's a number of slides here, I think close to 80 slides, some of these we're going to zip through. In fact, the first couple, hopefully, is just there to elicit a laugh. They're the two most powerful people in the world, right? I can give you a minute to think about them. You might think it's the POTUS, or someone in technology like Jensen Huang, who runs NVIDIA, or Elon Musk, but in fact it's these two characters, right? Jay Powell, right? No doubt that he is the puppet master controlling the monetary policy, and by some extent, to some extent, asset prices in the U.S. and globally. And then there's obviously Taylor Swift, who was one of the major reasons why we saw the economy grow at 5+%. I'm not sure that I agree that she is that much attributed to just the Taylor Swift effect, but no doubt her concerts and the rest of her broad enterprise is pretty darn impressive. So here we saw for 2023 pretty much green across the screen, right? The only red item, or in this instance just negative, is commodities, which kind of end of the year similar to where they were throughout much of the year. So again, it's nice to see pretty much broad participation across the board. We'll talk more about really where the primary lift was when it comes to U.S. equities, but again, whether we're talking the U.S., large, mid, small, growth value, international, emerging markets, fixed income, kind of hard to not make money. So encouraging after, again, a pretty dismal 2022. Now, the truth is, again, in some sense, really solid fourth quarters can be a little bit of stealing from the future years. So tempering expectations. I'm not sure we'll put up a similar quarter here in the first quarter, but again, nice to be able to put a notch in our cap on the fourth quarter of 2023. Headline for the last, let's call it 3 years, has been focused a lot on inflation, right? Directionally, that's positive. That's again why we saw the Fed pivot. There's been a little bit of a joke that Powell started the victory lap. I think if you asked him, he thinks that's still premature, and we'll see whether or not they hike rates 6 times, which the market seems to forecast, or just 3 times. But you can see, we look at headline inflation. Really, there's been a steep decline in energy prices, and that's been a reason why we've seen inflation come down quite a bit here over the last couple months. On the basis of where we are still seeing some stickiness in inflation is on housing, which we'll spend a minute on later. But again, by and large, directionally, it's our friend. I do think that there's a possibility we'll see, some deceleration in the rate of decline, right? Again, we went from 9.2% down to the mid threes here. It might take, more than just a couple months to get back into the low twos, but that doesn't seem like where we're headed. That's not just a story that's unique to the U.S. Again, perhaps overlaying this, of previous slides where you'd be able to see the numbers, you can just see, the major economies and the black line. Again, that line slopes down quite a bit. Emerging markets, much the same, right? Which is a fairly important phenomenon. Sometimes we'll see an environment where the developed market will benefit from a declining inflationary environment, and that won't be the case in EM. And good news is, again, EM, mainly because of benefiting from natural resources, has been able to hold off on what would have otherwise been a pretty ugly period for inflation last couple of years. Here's what I was referring to before, where we see, again, goods inflation has dropped. We're actually probably likely to see some deflation. The Chinese are manufacturing stuff, and exporting deflation is a real possibility. Service sector continues to be somewhat stickier. Although, again, if you saw the ISM for the month of January, it wasn't exactly all that promising in terms of maintaining some of that upper momentum. Really, it's shelter, right? Like, owner equivalent rent and some proxies for home ownership continues to be the sticky piece. We do think at the back half of this year, you'll see that will become probably more of a tailwind to the story behind inflation. But for the most part, again, it still is an environment where housing or shelter is consistently adding to the inflationary story. The forecast for inflation over the next 5 years, right? To the five-year forwards, about 2.5%, call it 2.6. Consumer is actually a little bit higher. They believe it's likely 3, and this is kind of gets back to the idea of like inflation expectations versus actual inflation. Powell talks about inflation expectations, and that's the idea that if you become anchored to the idea that prices are going to rise, you're likely going to pull your economic activity forward, and you'll create that higher prices or those higher that inflationary environment. Again, this is just the kind of trend directional you can see here, where headline 50-year average is 3.9. We're at 3.2 in October and November, again directionally going down. Core, we're stripping out food and energy. Again, you're kind of sticking around that 4 number, but you can see energy, they come off quite a bit at 4.5 and 5.5 in the month of November, and that continues to be the case. I drove in this morning, gas is at $2.59 for the regular stuff. I know the California crowd fell out of their seat on that, but the bottom line is, again, as we continue to see inflation decline, that's generally should be something that's good for the economy. This is inflation expectations outside of the U.S., right? Again, you can see Japan is looking at something that they would probably jump up and down about at 1% inflation after roughly 3 decades of deflation. The U.K., Canada, Australia, all kind of light teal. Shows inflation over the next 10 years likely to be a little bit higher than the previous 10. One thing that makes us, not overly excited about, the disappearance of inflation is the idea that historically one of the big drivers of inflation has been wages, right? So this is a positive in general, right? See wage growth year, right around, 4.3%. And so again, if inflation's at 3.5, give or take, this roughly is about 1% of real wage growth. But again, if you have more money, you can spend more. And so we just have to watch that. That could be in the circumstance where people will repair or rebuild their balance sheet, or take an opportunity to kind of put money back into the market, stock market through 401ks and like. But again, bottom line is the direction with wages is improved, but we don't want wages to get too high in relation to the inflation rate, because again, that can create some of that feedback loop like we saw in the 70s. The unemployment rate again here at 3.7% and inflation at 3.5 or so. We've got the misery index in the 7s, and that's good. I mean, we were at misery index in the low teens back in June of 2022. Labor market, right? Again, we'll talk a lot about the idea that hiring is lagging, firings are leading. The 12-month or excuse me, the 3-month moving average does suggest that payrolls are declining, and that makes sense, right? If you go back and kind of look at the charts when the Fed started hiking interest rates in March of 2022, we saw consistent job growth in the 500,000 territory, trend down. Here we are right around 200,000 or so for the 3-month average, right? So again, not expecting wage growth, not wage growth, excuse me, payroll growth to significantly increase over the course of the next few years. But if we can hold around that 150, 200, that's a pretty healthy place to be. And you can see the other stuff went back to this idea of leading, initial and continuing jobless claims. Initial jobs claims still right around 200,000. That's historically a very healthy number. The ongoing or continuing claims, that's ticked up a little bit, which right now is rough around 1.5 million. That just suggests that it's harder for people to find a new job. So we are seeing the JOLTS numbers still, 8-9 million openings. Those aren't easily being filled. Again, we'll not spend 10 minutes on every slide. I apologize in the lengthy here to start. This is where I think people who are in that kind of higher for longer view relative to inflation are very much focused on, will we actually see something resembling a reacceleration, so a no landing versus a soft landing? At some point, you have to ask yourself, have we actually already had the landing, right? But much like I've debated the word transitory and what that meant, I think this soft landing is becoming somewhat of a frustrating phrase to hear, because we either landed the plane or we haven't landed the plane. But if we do see a bit of a reacceleration in job growth, that again is going to give the Fed pause if we do think that, if they do believe that rate cuts are in the cards. One thing again, if you're and Claudia Sam was on this morning on Bloomberg, one thing you want to be sensitive to, if you really do think that we're on the cusp or brink of a recession, it's pretty evident that when you see a 50 basis point move in the unemployment rate over the span of 3 months, 3-month moving average, that we're pretty much in a recession. Now, what you can see here is you see the spike in the unemployment rate, the gray bar actually is before that. So, the recession will start before you even see those numbers, but it will be pretty evident to see that, as we get to a place where unemployment rate starts to tick up, that would be perhaps an indicator. We did actually see a little bit of an increase back in October as the unemployment rate ticked up, but it's come back down now. We're again hovering in that 3.7 territory. Global unemployment, again, similar story, right? Unemployment rate in Europe and Japan have declined, right? We saw a much bigger spike in the midst of the pandemic. Yeah, frankly, it has a lot to do with kind of our economic system. But the truth is that as you see an improving labor picture, it generally lends well to confidence, although inflation has been a bit of a headwind. You can see again across the board here, U.S. consumer confidence is improving a little bit, as is the case in Europe and Japan. Um, uh, Here are the soft data, right? Again, this is to get a little bit more granular in the U.S., right? Consumer confidence, which is just kind of looking at how you feel in general. Then there's the present situation versus expectation survey, and lastly is the perception of a recession. This is more of the broader audience versus just talking about economists. So again, directionally, it's nice to see confidence proving as a bit of a contrarian indicator. Too much confidence can be a little bit of complacency when it comes to the markets, but by and large, again, getting people feeling a little better about going shopping or just what's going on at work with respect to wages is a positive. And then the idea of a recession odds declining is a welcome news. I will say this, I've used this analogy with some of my client meetings, right? Like we've all ridden a bicycle, right? When you're riding a bike 20, 30 miles an hour, you feel like you're kind of, just in a zone, right? And very difficult for you to be kind of thrown off course. But if you just hopped on a bike or you're getting ready to slow the bike to stop, you notice that there's a little bit more of a wobble effect. So as the economy has slowed somewhat, and there's an element of fragility that comes with that slowing down, it's just we would be mindful of one or two exogenous factors, perhaps creating an opportunity for the economy to slip into recession. Again, not calling that, but just saying, hey, let's be sensitive to that possibility. Here's the consumer, right? You can see the savings rate, which spiked. Obviously, that's that gray line up there. Where the savings rate was almost 16% back in 2020. We're back down to right around 4%, which has been in line with the 20-year average, right? It's much lower than the historic average, right, which is about 8%, going back to pretty much World War II time. Again, that's not a great development, but it's not a horrible development either. Still, we're happy to see a positive savings rate. You could say right around the GFC time, the savings rate was half that, right? So we'll just see what takes place with balance sheets over the course of the next 12 months. The excess savings, which we saw back in call it March of, actually more likely July of 2020, excuse me. That's come off now. We're still about $1 trillion estimated according to JP Morgan in excess savings. So good to know, right? In an economy that's 25 trillion, that means about 4% of GDP is there that could in theory be spent, but again, it's not likely to come overnight. And then revolving consumer credit, right, just means that people are back putting money on cards, right? We've seen that increase. There's headlines like massive amounts, all-time records. I mean, on an inflation-adjusted basis, you can see we're still well below where we were back in 08. But fact is, we'll watch that, right? And again, this is that other piece there we're talking about. Is another way of looking at the same slide, where the outlays in relation to wages are heading back in a more positive direction. When orange is considerably above blue, that means you really don't have a lot of excess cash flow. When you see blue north of orange, again, it means people have some free cash flow, right? We like that in our investments, and frankly, we all like that when we think about our household finances. Here's the one thing that we're watching though, right, relative to delinquencies. I grew up in the 70s and 80s, as did Tom. We had this concept called layaway. You'd buy something, or at least the store would hold it, and you'd come pay for it over time. Now, again, it's the opposite, where you have instant gratification, you get the product, and you can buy now and pay later. That's again something that is worth monitoring, and we've seen some delinquencies tick up, and you can see it's really much more the younger cohort, although that we do see a little bit of increase in the 40 to 49 crowd. Again, the red and gray represent kind of the millennials and Gen Z. Not too surprising to see there's an increase in delinquencies there, especially as student loans have restarted. But again, we want to see if this is something that's an elongated trend. Housing, just spend a minute on this, right? So, home prices continue to be fairly unaffordable based on historic averages, right? You can see that where that line is. You got to go back to, peers in the, early 80s, and that was really a time when interest rates were just astronomically high. The good news is for the people who already own homes, right? The average balance or average, mortgage rate is roughly around 4% or so. Um, and what's really interesting, again, people are like, why the heck did the home builder stocks do so darn well last year? When you have all you hear is housing's flat or there's so little inventory. Well, again, people aren't moving out of their existing homes where they have mortgages. This is the D.R. Hortons, the Toll Brothers, the KB Homes, putting new homes to the market. And again, you can see that existing homes are really quite low. You go back to really levels we saw post GFC, whereas, new home sales are where the lion's share of that activity or that volume is. And we can see that in permitting as well. Commercial real estate, right? We talked a little about this last year. Continues to be a question, right? There's a maturity wall over the next couple of years, right? We do, as we stated at the time, we do believe it's a containable risk, but you can see vacancies across apartment, industrial, office, and retail all have moved higher, right? It's much more pronounced when we look at office space, which is the gray line here on the left. The interesting point though is too is on the further left you see cap rates, which is really kind of a measure. Think about PE ratios when you invest in stocks. You think about cap rates in real estate. So the fact that cap rates are still below their long-term average suggests the market hasn't cleared, right? People who own these properties are hoping by divine intervention or otherwise that rates will come down, they'll be able to refinance, or markets will normalize or calm down. I'm not sure I believe that. You'll probably see some further clearing in the real estate markets. And then again, back to my point about shelter, right? We are seeing this in the data, right? Rents are coming down, but because of the lag effect of how it reports through PCE and CPI data, we haven't seen that. So, by probably May, June this year, you start to see, OER, owner equivalent rent, or shelter become, again, a positive story within the inflation picture. Bank story, right? This is interesting, right? So bank lending has, decelerated a bit. And the question is that because they're concerned about balance sheet? Is it the function of their concern about the economy? Or has it just been a significant opportunity that's been opened up through a regulatory regime that's been quite conservative post GFC, where private credit, private equity, private real estate has absorbed a significant amount of that new borrowing demand, right? Good news is we do see that bank deposits have stabilized, right? You saw in 18 months ago that start to trend down and really picked up in earnest, as you can see the small banks back in May of last year. And while their net interest margin has to some extent shrunk as a result of having to pay more to keep depositors, the fact is just not seeing deposit flight's important. Banks do look relatively attractive when you think about valuations. Predicated on the fact we can avoid a recession over the course of the next 12, 18 months. Again, last thing I'll say on kind of rounding home the recession story, you get a lot of green on the right hand side, right? That's a positive. Where you worry more about, a recession likelihood is a combination of some weakness in employment, some pressures on margins, which force businesses to make decisions about where they spend money. Consumer continues to spend. We see that both on discretionary as well as essential items. And industrial production has actually shown some signs of life. We've had 14, 15 straight months of contraction within the ISM manufacturing, but directionally, some of the underlying data there has been, something positive to see. So again, I always hate to try to predict recessions. It's like trying to predict what the stock market's going to do. But these are positive signs when it comes to thinking about, the odds of recession being low. Last thing I'm going to hit on here, myself on the macro side, I'll turn over to Tom in a minute on, one time. Actually, I'm sorry, I'll come back to that a little later. Sorry, let me hit on, the dollar here, right? So think about 2022 was a great year for the dollar and not a great year for stock markets. 2023 was not a great year for the dollar and a pretty good year for the market. We saw a couple currencies where the dollar did a little bit better, right? Dollar did a little better against the yen. Dollar did a little bit better against the euro, but by and large, as the dollar weakened, that was a positive for asset prices. I think that, probably is a trend that will continue. Sorry, let me go back to the slide here. In 2024, excuse me, where we have this idea of the Fed likely to start cutting rates. You couple that with deficits and debt, and you could make the case of why the dollar might not be the safe haven as it's been the last 18 months or 24 months, where people have been nervous about the global economy. And when you see periods of dollar weakness, that tends to bode well for overseas equities, right? So perhaps again that could be the start of a longer cycle. We'll spend some time on that as we get to the global equity section. So I'm going to transition to the U.S. equities and commodities. By the time we get to commodities, I'll turn it over to Tom. I guess I'll have exhausted your eardrums, or my vocal cords will need a rest. But we're going to get into a little bit more particulars here in the U.S. now. Right. So across the board, as we talked about early, good story, right? S&P up 24% on price, 26 when you factor in dividends, NASDAQ up 43%. It's interesting, right? Again, do the quick math. NASDAQ dropped about 30% in 2022. So to go down 30, right? You actually got to go back up 40. So we're still actually a little bit below our all-time highs on the NASDAQ, as is the case with the S&P. The Dow actually hit its all-time high a couple weeks ago. Russell 2000, again, the small cap stocks, almost all of that return came in the last 10 weeks, right? And the Dow, the sleepy Dow, up 14%. But again, the Dow was, fractionally down in 2022 and up in 2023. So if you own the Dow versus the S&P over the course of the last 2 years, you actually are a little ahead. And again, you can see here what's really interesting, and I have another slide on this a little bit later, but maximum drawdown from the 2023 high really wasn't that significant, right? We saw, again, that volatility be somewhat muted. And so when you have an environment where volatility is not all that present, usually see more kind of breadth or dispersion, positive dispersion. We didn't actually see that, which we'll talk about in a minute. Again, the index drawdown from 2022, right? Which was October 22 is the new bull market by most definitions, is 10%, right? Which is that correction we saw, roughly in the summer here, just a few months back. But again, hard to look at that and not feel good about what you're seeing here post or as a 2023 postmortem. Even going back the last 8 years, that line slopes up and to the right, looks pretty darn good. As a tease about forecasts, right? Again, the analyst community tends to focus on the idea of let's throw a number out there that's not one for me to get fired or embarrassed, which is, hey, let me estimate the market's gonna get somewhere between 5 to 10%. Right. And well, again, that was probably optimistic for last year. It turned out to be, a real under estimate as to where we landed. Right. S&P up, 24+%, puts it, really, to the right here. And this is kind of cool. It's going back 150 years and looking at, how often markets end positive and when they do, what percentage positive returns we see. Again, we'll skip the forecasting for today, but at the index level, we'll spend some time on giving our outlook at the end of the presentation. Again, here's the interesting piece of respect to some of the data points. Again, if you look at the 5 best days, right, the highest was a +2% actually on January 6th. And the lowest best day was 1.89%, which we hit 3 different times in both January and twice in November. And the worst 5 days, right, the worst day was down 2% when there's some talk from the Fed about the prospect for much higher interest rates. It was not on the back of another 75 basis point rate hike. But we saw a little bit of a spook of the market in a month or so later, not even really about 2 or 3 weeks later, with the banking crisis. And then again, from that point forward, the worst day was March 22nd. Again, another day kind of in that window there. But really, really uncommon to see markets not move more than a couple percentage points. And you can see in for 2023 that number of negative days for the S&P, roughly higher than where the positive days were, but days with a 1% move were just 63, right? Half of the number we saw back in 2022. So I know a lot of us welcome the idea of less volatility. Again, looking at the S&P as we think about really where we are today and where we think things might head over the next few years, right? Market's not cheap, right? We're at a multiple of 19.5. Some of that's driven by market composition, which we'll talk about. Dividend yields, $1.50, right? Historically quite low. And the 10-year at 390, does represent a little bit of a real kind of tug of war. Actually, the 10 years over 4 this morning. Again, expectations should be tempered a bit, right? Doesn't mean that markets are going to fall. It just means the idea of putting on 20+% returns every single year is it becomes more and more difficult when you got a market that's priced at 19 and a half times. Again, you can look at just from 2000, where the S&P was 1527. It's kind of threefold in that time, right? So again, benefit to investing in the long term, but at the same time, being mindful of where we are today. This is the sector breakdown. Again, pretty interesting to kind of dive in here. Fourth quarter was generous everywhere except energy, right? And again, that might be welcome news unless you're long a lot of the oil stocks, especially when you think about your filling up your car, or today natural gas and oil prices heating your home. Again, you can see that the somewhat lackluster performance came from the energy sector, which was down on the year. But you can see in the defensive areas, which is consumer staples, healthcare, and utilities, all either low single digits or even in the red, right? Utilities had a really rough year. It has a lot to do with some higher interest rates being perhaps a bit of a challenge, right, as the bond proxies for stocks, as well as some questions about spending on renewables. The heat map, as I like to look at it, right? This is the last 3 months. You can see again some of the familiar faces, right? The Microsofts, the Googles, the Alphabets of the world, actually Amazon's of the world. And then you see some other names in there that it's pretty impressive figures, right? Vertex up 18%, or Verizon, right? The sleepy Verizon up 24%. But again, kind of a cool way of looking at this. The bigger your square, the bigger the percentage you are of the index. So you can see, Tesla, a tough fourth quarter, is the only one of the Magnificent Seven that didn't really contribute in the last 3 months of the year. But again, as I look at that, much different than we looked at the same slide back in October. This is what I was alluding to before with composition and the concern about concentration, right? So you look at the top 10 stocks in the S&P, they contributed 86% of the return, right? The other stocks only about 14%. They represent the top 10 stocks represent 32% of the index, right? You can go back and really the last 30 plus years and not see anything like that. We have seen prior periods like the Nifty 50s, where Kodak and Polaroid and IBM were massive constituents of the index. But when you have a significant amount of the market in a handful of names, it's pretty clear, obvious, right? That those names will have a much more significant impact on the market return. Doesn't necessarily mean that's going to have a significant return on or impact on your return unless you're very much tracking the market. But again, just something to be very sensitive to. And you can see earnings contribution, right? Like, it's important that we're mindful that, big companies do contribute significantly to earnings, but their percentage in a whole is still quite modest. So when you're 30% of the index, but you only contribute 24% or 22% of the earnings, right? You might have too much influence on client performance, portfolio performance. So another way of looking at that, right? If you think about the top 7 stocks, a lot of the return, which is on the right side here, came in the form of PE expansion, right? The multiple rising. Again, we don't usually complain about making money, right? And I'm not here to, but it's also nice to see when earnings is a bigger driver behind, that performance. Now, some of earnings, which improved to the back half of last year, was about cost efficiency and some top line growth. We'll see if that again continues here in 2024. When you think about AI and some of the other buzz phrases that are driving a lot of the growth stocks. Let me go back here. This is a point I like to make to clients as well. If you go and think about the market, and this goes back, really 30 plus years, equal weighting of the S&P constituents will actually serve you quite well, right? We've seen that in, periods where markets become overly concentrated, right? You can look at this, steep peer decline in 2008. You can see it again in 2022. The idea is equal weight means I'm much more agnostic about my feelings on sectors or industries as well as companies specifically. So again, it's not saying run out, sell all your S&P funds and buy equal weight versions of the same holdings, but again, it makes sense why someone might want to have a little bit more exposure to the rest of the 400 of the 500 companies in the S&P. Again, real quick here, just why valuation matters, right? We talk a lot about the idea that when markets do well, right, we rewarded for that performance, but we have to just think about what that means maybe for the future, right? So when you have an S&P at 19 times, forward returns are likely to be more pedestrian. I think mid-single digits, 6, 7%. And again, we have a slide to tie that home in a little bit. If I'm putting new money to work today, I'm going to be very sensitive to valuation. If I've got existing capital, I'm not likely to go ahead and rush out and sell because again, I'm somewhat constructive. However, again, it's safe to assume that the stuff that's worked really really well, that the price reflects that. This gets back to the idea of growth versus value, right? Again, when you see on the left-hand side here of this busy slide, I apologize, it is busy. The forward multiple on value is 15 times. Forward multiple on growth is 26 times. So roughly, 60% higher. The long-term average, you're much closer with value stocks, and so it stands to reason that you're probably rewarded for having a little bit of a bias there in the short term, right? Again, when treasuries tend to offer higher yields as well, value stocks tend to outperform a bit, right? That's a long duration concept. I don't know that you want to think about that the same way with the Magnificent Seven stocks, for the most part, just because they're massive cash flow generative companies that are generating earnings today. It's also the argument's really about those future growth companies where they tend to have a little bit more pressure when interest rates are higher. Again, it's not to cherry pick the argument here. You still, again, big cap growth stocks are expensive. They're a little less interest rate sensitive, as we saw obviously in 2023. Earnings growth is the name of the game here, right? Like if earnings grow at 12 to 14%, which is the consensus view from Wall Street up until really a month or so ago, it's come down a little bit, but still, again, you're talking high single digits, if not low double digits. Where is this going to come from, right? Someone's going to come from top line, right? That's the revenue number. It's safe to assume that if the economy is going to grow at 2%, revenue is probably not going to grow at 15 or 20% in the composite, right? Individual companies for sure, but by and large, it's you got to imagine revenue numbers, probably in that mid-single digit number. Margin improvement, yes, some of that will come through AI and automation. Some of that will come through, lower commodity prices. But again, there's so much blood that we squeeze out of the rock, and margins have been really healthy for the last few years. So you're not going to likely see a significant amount of margin improvement, right? You saw margins decline last year, right? Hopefully, we get back to a point where margins are flat to slightly up. And then, share count buybacks, that's been a political hot potato, right? I do think you'll see some improvement with or some increasing buyback activity as CEOs are less worried about recessions. The political atmosphere is less bullying, big business and buyback stock. And so again, if margins can hold in that high 11, 12 territory, that bodes well for stocks if earnings are going to grow in that kind of 10% territory. Again, small cap stocks that I talked about a moment ago, right, ripped in the fourth quarter, right? We had a really impressive last 10 weeks. They still are quite inexpensive historically. The market's concern about small caps is lack of profitability or a high leverage, high amount of leverage. You can slice and dice all markets, and so you'd want to be in higher quality or profitable small caps, especially if you still have concerns about a recession. But the point being is, when you look back in other previous instances, October of 2002, March of 2009, small cap stocks ultimately traded a pretty big discount then, right? And that discount still exists today. So there's a possibility that we could see some healthier performance from small cap stocks continue into 2024 and 2020, even in 2025. Again, I'm not going to spend any time on this one just because it's an eye chart, but you can see that there's a lot of information here. The crib notes version is value stocks are cheaper. Historically, that would make sense, but they're cheaper but on a relative basis today than they normally would be, which means that if I got new money to put to work, it's not a bad place to focus my energy. Again, this is what I was talking about before with earnings growth, right? Flat last year, right? Again, positive, really in the last 2 quarters, right? We're in the midst of fourth quarter earnings season as we speak. But the first 2 quarters, as well as the fourth quarter of 2022, sorry, still not quite there. I wrote a check with 2023 the other day. Earnings were flattish here. We're back to that 11, 12% number based on the street. You will see earnings growth in Europe and Japan, and you'll see pretty significant earnings growth in emerging markets in 2024 based on estimates. I'm going to turn over to Tom here. Tom will take us home on the kind of U.S. story with commodities, and he'll run with global and fixed income. So Tom, the floor is yours.
All right. Thank you, Jeff. We got our money's worth out of you today. Appreciate it. That was great. To jump right into the oil markets, this is a slide that we showed last time, which I really like this slide, talking about production in the upper left-hand corner first with US, OPEC, Russia over the course of, call it the last 4 or 5 years. And, the growth in the US, pulling back a little bit with OPEC and with Russia as well. As you look at the right side of the chart, really the price of oil, something we brought up last time was the strategic petroleum reserves, and something we were watching just to see what was the impact of first the United States selling oil out of the strategic petroleum reserves, and now being in position to replenish that and to buy it back. The good news is the United States, and this is a very, very positive story so far, sold all that oil for $95 a barrel on average, and now has set really $79 as the ceiling as far as what the U.S. government would like to pay for oil. They've already bought back about 9 million barrels at $75 a barrel. And as you can see in this chart, there's ups and downs, that peak being March 8th, 2022, or at least the most recent peak. Now we're $72, $73, just under 73 as of this morning. So still in that territory where on a monthly basis, the plan is to continue to buy back into oil. I think we've all probably felt it at the pumps where, our gas prices have been a little bit lower, which has been a nice relief because our prices were higher for a while there. And generally, again, I hats off to the current administration for just doing this in a thoughtful way, buying back in, replenishing the reserves, not pushing oil prices back up dramatically so that we're all getting crushed every time we want to go on a road trip. So positive story in general. Thanks, Jeff. This slide is kind of, as Jeff would like to say, an eye chart. There's a lot on the left-hand side of the screen. Generally speaking, outside of gold and copper, if you look in the 2023 column, the furthest to the right on the left-hand side of the slide, gold positive, copper positive, many of the other things very negative. And that might surprise the average investor looking at it and saying, geez, lithium, every battery needs lithium or nickel or whatever it might be. They have really very down years. Whereas then if you look on the right-hand side of the screen, the commodities there are listed, coca, iron ore, and rice, very large price changes in 2023. If you're an investor, you're thrilled about that. If you're just a consumer of any of these things, not as great. We're suffering definitely still some at the grocery store as we go out and buy, all these different things, and as many of them are processed into goods that we use every day. So again, kind of double-edged sword there. Great if you're the investor in it, tougher if you're actually just the consumer of it. So next slide. Thanks, Jeff. Moving into the international and emerging markets. If we look at, just from a return standpoint, I like looking at, there's the 3-month and then the 1-year columns on these. And as Jeff had alluded to before, the S&P 500, great year, the NASDAQ, even better as far as returns. But if you look at a lot of the international markets, there's some positive stories there. Europe actually did pretty well. If you're looking at the 1 year, and you see France over 20%, Germany over 20%, Spain 27%, Italy 34%. A lot of very positive moves in global markets. Latin America 33%. Japan has done extremely well. Asia, a little bit tougher on the China side of the ledger, down, if you look, 9.2%. Hang Seng and Hong Kong down 10.5%. So we definitely see some, again, tale of two types of returns, but we've talked a little bit about China. We're going to talk a little bit more about China. a little bit later in the presentation. So Jeff, if you don't mind jumping to that next slide. This is something, Jeff mentioned a little bit, the weakness of the dollar or relative weakness or strength of the dollar compared to other currencies. What's interesting, if you look in the 2023 heading, and then it says local and then USD. So essentially, if you look at all of the returns and you jump over to selected countries, it says Japan, UK, France, Canada, Germany, et cetera. You start to see, what were they, how was the return essentially in the local market compared to US dollar denominated? And because, well, as Jeff mentioned, the currency strengthened against some, weakened against others. You see the US dollar denominated side of the ledger in most countries is a little bit higher. We'll use the UK as an example, 7.7 locally, 14.1 in the US dollar denominated. So weaker dollar compared to the UK, better return, on the actual in the actual investments. So if you don't mind, thank you, Jeff. So we showed this slide last time as well, and this is just one more argument for international exposure. And you look at the purple as stretches of time that the developed international markets outperform the U.S. markets, and you look at the dark gray there as periods of time that the U.S. has outperformed. And they do flip flop back and forth, and you have long stretches of time. If you look at the dark gray on the right hand side of the chart, right, 14 years, the U.S. has really just outperformed international markets until recently. And again, you can kind of see it flip-flop back and forth over the course of time, going back to 1971. Next slide, please. So this is back to the PE ratios and valuations. In the chart on the left-hand side there, you can see the S&P PE ratio 18 compared to the 15-year average 16.1. So PE ratio over that 15-year average might say, hey, domestic US S&P 500 type stocks a little bit more expensive. As Jeff mentioned, on the growth side, that's much more exaggerated. On the value side, there's still some opportunity there. If you look at the international developed markets, the MSCI EFA there, 12.9 compared to 13.7, and then the emerging markets, pretty much at the 15-year average, 11.6 compared to 11.4. So again, up to us to help you be thoughtful as we allocate your portfolio, as we make changes and decisions. Where do we want exposure? To what degree? That's something we're paying close attention to. As I mentioned, China would come up in the presentation. Close eye on China's economy, second largest world economy. And if you look at some of the underlying factors, jumping down actually first to the lower right-hand side where you see residential property prices on the decline. This is the number one way that normal citizens in China look to build wealth has been through residential real estate market, and it's been in decline for the past few years. Then you look at equities are going down, residential properties, like I said, going down, and income confidence going down. If you look at the top chart there where it says household deposits and household loans. So what you see there is normally you'd want to say, oh, loans are going down, that's good. Debt is probably going down with it. But because people are losing such confidence in the residential property market, people are hanging on to that money and not building the wealth that they had been building over time. So this is it's a tough time, for China's economy. It's going to be interesting to see how Xi combats it because there are so many factors and so many things going on at once. And Xi is kind of built the cult of personality, where if you look at a lot of different parts of China, Xi has actually purged people out. Right now is kind of going through the military, and it's something that it's such a large country. It's difficult for obviously one person to run it just by themselves. And it will be interesting to watch as we continue to pay attention to what's going on in China and how they react to all these different factors. As it relates to India, again, India, kind of the opposite story, where if you look on the left-hand side of the chart, you have kind of the three bars there all very high, and it's real GDP growth by country year over year. And the purple and ultimately the darker gray is to say, okay, like moving forward, so 2023 and then beyond, India has really shown a lot of strength. Where if you look at the blue in the past, China was leading the charge, but now if you look at it, their GDP is not growing at and not projected to grow at the same level. The upper right hand quadrant there, working age population growth. So again, China with a young working age population, ultimately countries and companies are going to be looking for uh, educated workforces. And China, because or China has been that, right? And now many companies are actually getting out of China because of regulation, because of wage growth in China, and looking to places like India to say, okay, we have a huge highly educated population, and we have a place to essentially move our manufacturing, or some very high tech could go to places like India. um, Jeff, if you don't mind, jump to that next. uh, so to switch gears a little bit, Jeff had mentioned Japan, and we saw kind of the dollar and what it was doing in relation to the yen. It's interesting because Japanese companies right now are very appealing. Um, Even though the market has already gone up quite a bit, so many of the companies in Japan are sitting on a ton of cash. And so ultimately, it makes buying these companies uh, relatively safe. There's some price protection because of the cash. Uh, Companies are paying dividends, companies are buying back stocks, and ultimately they're even diversifying their businesses by through M&A, so acquisitions, mergers and acquisitions. And it's interesting, on the right hand side there, it says deals in 2008. As I looked at the current situation, it was hard not to look back at the past. And there were Wall Street Journal headlines in 2008 and 2016, very similar type of thing. And now it seems like many of these companies and the Japanese markets as a whole are really paying off on a lot of these past investments, and really looking at their attractiveness right now just based on how much cash they've got. Next slide, please, Jeff. So a big part of what's gone on in Japan, if you look at the two left charts, inflation expectations by country, and then also the interest rate expectations by country. Interest rates in Japan have been very low. They're the blue line in that bottom chart, where it's essentially been at zero. If you look from 2015, 2016, they've started to perk up the last couple of years, but it's created an environment where Japan's really been able to, I mean, these companies have been able to buy or borrow money, I should say, at zero or near zero rates for a very long time, and they've really been able to capitalize on that. The past year and a half. Inflation, if you look at it, their expectations going back up to that top on the left hand side, inflation is starting to creep up. In Japan, if you look at it, same in the Eurozone, same in the US. US looks a little flatter again. Hopefully we've got it under control, but generally speaking, if you look at Japan, again, the companies are a good buy right now, to kind of put it concisely. If you don't mind, flip over to the next page. I think Jeff will dive into the fixed income side of things. So switching gears to the fixed income market, after the Fed, again, raising rates, trying to cool off the economy, trying to cool off inflation. One of the big beneficiaries has been the fixed income side of the ledger. Yields have gotten better, overall returns have gotten better. And if you look really kind of up and down this chart, there's not a whole lot of red until they start talking about correlation. So it's not yield and return. Those are pretty much all positive, whether it be treasuries, whether it be investment grade corporates or convertibles or high yield. There's been really positive story overall on fixed income, really A to Z, which has been nice. After such a long period of time, call it 20 years of really, scraping and clawing for every little bit of yield that we've all done, either as financial advisors and planners versus clients looking and saying, hey, trying to get more conservative as I get older and I'm trying to put my money in a safe place, that yield hasn't really existed. It's finally coming to a point where, we can get a little bit of a yield. And not only are bonds, as they say, bonds aren't supposed to make you wealthy, they're supposed to keep you wealthy. The idea of that is great, but it's even better when the yield is there and the return is there to bolster the rest of the portfolio. So, Jeff, if you don't mind, we'll flip to that next screen. So this breaks it down even further into treasuries, munis, and if you look over 1 year, 3 year, 5 year, the 1 year, if you look, has been really the best area and the best spot to get that yield / total return. For all the reasons I just mentioned. It's really what's interesting. It's as you read the headline, tune in during the fourth quarter. So much of it came during the fourth quarter, where we started to see the values shoot really right up. If you look at that 3-month column, you can see so much of the 1 year return is due to that third 3-month period, the fourth quarter. All right, so this slide I really like because it's a look back, the current situation, but then also a year ago. So the left-hand side is the current situation, Fed funds effective rate 5.33, 2-year treasury 4.26, 10-year treasury 3.84. And then you look at, there's a little inset on the left-hand side graph where it talks about a year ago, again, 4.33. So the federal funds effective rate was about a percentage lower. And if you look at the 2-year treasury yield at 4.4, that was a little bit higher. And then again, the 10-year treasury a little bit lower. So the yield curve is moving. It's nice to just be able to take a look back, look at that last year, say, okay, that's where it was, this is where it is now. And conditions are going to continue to change, and we're going to be able to say, okay, as asset allocators, as we look at, overall portfolio's, and we're paying attention to duration of the bonds within the portfolio, and as the composition of an ETF or a mutual fund changes, this is something we're paying attention to, and making sure that while it is an uneven yield, if you look at a bond mutual fund as an example, they manage portfolios and they set up their portfolios in all different ways. Sometimes it's a ladder where they have maturities really at every year. Sometimes they'll call it a barbell where they'll have short-term as well as very long-term maturities. And other times they'll have what they'll call a lumpy ladder. So they'll take advantage of, there's a really good yield over the 3-year, there's more in the 5 and some in the 10. So you may have maturities along the way, but it might be more heavily weighted in certain years. Or it could be a bulleted approach where it's really, the intermediate bonds are doing extremely well or have the greatest opportunity. And again, our job is to pay attention to that, look at where the duration is, look at where the opportunity is, and allocate things accordingly. Perfect. Thanks, Jeff. So with this slide, as you can see, as the quarter progressed, yields rose, spreads tightened. So this is something where it's just important for us to be paying attention to the credit spread, treasury rates, yield percentiles, spread percentiles. Ultimately the central bank rates, bond yields, they're high globally. And it's likely that they'll remain that way, through 2024 before coming back and retreating. So as we make changes within the portfolio, this is something that people very often think of a bond or a bond portfolio like a CD, where you could just buy a CD and you can own it and just keep it, and that's really it. It's going to pay you X, at the end of the term. In the bond market, there's more complexity to it, and it's just something that we're paying attention to, and especially while rates are still attractive, and really before yields potentially drop, in late 2024, early 2025. So as it relates to high yield bonds, so default rates still on the very low end. If you look at the little box there above the chart, The default rate, long run average 3.54, currently 2.88%, which is again historically low. Spread to worst 5.64 compared to 3.77 right now. And really the recovery rate, 40.2 compared to 35.7. Spreads are tight. The key with this slide, and just to kind of boil it down, is don't chase yield. It's not really worth it in the high yield space, just based on a lot of those numbers. So, we can definitely invest there. We can get a good return, but like don't take undue risk. Essentially, is what that slide's meant to communicate. All right, so interest rates. So we weren't going to get out of this conversation without talking about the Fed and interest rates. With what's been interesting is as you watch, if you watch CNBC or you read different things about where the Fed's head is at and the signals that Jerome Powell has given versus what the market thinks is going to happen. Everybody was kind of counting the number of times that interest rates were going up, and now we're more in the prediction game of how we think interest rates could potentially go down. And if you look at really just end of year estimates in blue saying, this is what the Fed thinks, 4.6, 3.6, down to 2.9. And then you think about the market saying, hey, we think it's going to go down faster and there potentially could be more cuts. That's going to impact returns. That's going to impact yields on bonds and the value of bonds. And it's really just economic predictions, and it's predictions of what the Fed is going to do. They don't match up perfectly, which everyone will adjust their average, their numbers or their estimates. The market will, the Fed will, depending on conditions on the ground. And again, I think it's something that we are paying close attention to, watching in the portfolio and managing within each one of the strategies. I mentioned CDs before. CDs, it's funny, they are giving us a better rate than they've given us in quite a long time now. As you look at history, if you look down at the bottom, 1984, 1989, 1994, 2000, 2006, all the way through 2018, it shows the S&P 500. It shows 6-month CD, peak CDs, the bond portfolios, and then also a 60-40 portfolio. And there's, I know, a temptation that, especially with CDs, once they hit 5%, everybody was like, they're at 5%. We should take a bunch of money and put our money in the CDs and just kind of set it and forget it. And I would say the challenge with that ultimately is, if you look at where inflation is, if you look at kind of the total return of the portfolio, there's usually a lot more out there. So even when CD rates are pretty good, you have other opportunities or other alternatives where, if you're invested, then your potential for a reward is much greater. And it's interesting if you look over these just year or 2 years slices, kind of what the market's done, what's gone on essentially at the end of rate hiking situation, like what's happened that next 12 months is there's a lot of return available in a lot of different categories. And CDs, long story short, aren't always the best place to be during that stretch of time. All right, so on to asset allocation. I'm going to cover a couple of these slides, and then I am going to turn it right back over to Jeff. And it is interesting as you look at, the kind of the case for diversification, which I feel like we come back to quite often is, why should we diversify? Why should we have exposure to different parts of the market? And really, it's just different things do different investments do different things in different market conditions, right? So if you put money, in this case, way back in the beginning of 1926, like what would happen if you're investing essentially like $1 into each of these things, and what was the growth over the 97 year period, I should say. And there are so many things that happen along the way. If you look down at the bottom of the chart, I know it's a little bit small, but so many different moments to look at and things that impacted the market, some much greater than others. You can look at corresponding dips, to see things that were much more impactful, whether it be an oil embargo or September 11th or the tech bubble bursting or 2008. And then there are probably a million more things that could be on this list that we worried about at the time, whether it be Ebola or Brexit or something like that that may have had its moment in the sun as it relates to volatility. But in the end, the argument is for investing over the long term, diversifying your portfolio, owning a number of different asset classes, and making changes to that over time to make sure that we're adapting to what's happening in the market. The next slide is a periodic table of returns. So, it kind of just shows you that rotation. The 2023 numbers much better to look at than the 2022 numbers. If you look at 2022, commodities were essentially the big winner there at 16%, and you look this year, growth stocks 41%, right? And commodities were down 8%. So just another slide, case of diversification. We'll probably continue to show this slide because we are such believers in it. And we do believe it's just such an important part of a healthy, well-diversified portfolio. Importance for diversification. I love this slide. This is one that I talk to many clients about because I think, this is important as you think about risk and return, right? They always go together. And we're always trying to say, okay, we're going to look at time frame, we're going to look at risk and return, and we're going to settle on a strategy. And so if you look down at the bottom, just below the legal disclosures, it talks 100% stock on the left hand side going all the way to 40-60 on the right hand side. And what's interesting is if you look at average rates of return, right? So if we start with 100% stocks, it's 10.7. And then even if you skip all the way over to 70-30 or even 60-40, the average rates of return 70-30 is 9.8, right? So you're at 0.9 difference to get rid of essentially 30% equity, right? If you go to 50-50, it goes down to 9%. So it's a 1.7% rate of return on average that you're giving up. And then you look at the worst case scenario, which is really the bottom of the blue bar, and then the top of the blue bar best case scenario. You give up 10% on the upside on that best year, and you give up 24% or 23.3% on the downside, 50-50 versus a 100% equity portfolio. So we're always talking about protecting that downside, and making sure that we can capture as much of the upside as we possibly can. As your time grows short, as far as when you're going to start to need to take income off the portfolio, reaching for that 1.7%, going from 50-50 all the way to 100% equity, is much less valuable than protecting against that big downside. That's essentially what this says is, again, diversify. We want to pick a portfolio that makes sense for you and your situation. And yes, we know we could be giving up some upside potential, but the idea is that as you get closer and closer to retirement or needing that income, we need to protect against the downside. This next slide, I think, is the last slide I'm going to be covering. I'm going to turn it over to Jeff. Really is just, if you look at the range of the stock and bonds total return, over a 1 year, 5 year, 10 year, 20 year. So you see some negative, obviously in the 1 year, you see much less negativity over the 5 year, a tiny bit on the 10 year, just in stocks, not so much on bonds or a 60-40 portfolio, historically speaking, and everything's positive on the 20 year. So, yes, there's going to be volatility if you invest for the long term. Historically speaking, things have worked out swimmingly, as many of you know, by being long-term investors. So with that, Jeff, I'll turn it over to you. Thank you very much.
Thanks, Tom. Appreciate it. Yeah, give my vocal cords a nice rest there. Yeah, so folks, just to come back to, we talked about earlier in the slide, diversification, actually on the deck a number of times. Talking about volatility being, somewhat anomalous in 2023. I actually am one of the people who leans into volatility. I love volatility. I know that's gonna, drive people crazy, but volatility is what creates the risk premium, right? Without volatility, markets tend to do, less good things, right? But I do want some some volatility. Those dislocations are ones we want to be able to take advantage of. 2023 had a drawdown of 10%. We've talked about that. It was really kind of July to October, right in line with averages, right? We see corrections usually once a year, right? The average decline is usually about 14%. So to only go down 10 wasn't nearly as painful. But, I remember having this conversation with people right around Halloween, and it felt bad. It always does in the middle of it, but, it's worth riding through. The importance back to this diversification piece. I know kind of most of the audience has heard that from us individually or over the course of their investing career. And we're not trying to, browbeat you with something you already know. We're just speaking to that diversification is probably going to become more valuable in the shorter term, right? We saw this big increase in correlations, right? Where, everything went up or everything went down kind of in lockstep. That was very much the story in 2022 with, pretty much, stocks and bonds both declining. 2023, everything went up, right? As you get back to a more normal environment, which is oftentimes a time when inflation starts to dissipate a bit, that dispersion, means that if we're thoughtful around how we deploy our clients' capital, we can take advantage of where there's relative value, right? Like, at any given moment in time, at the margins or at the edges, we might think, hey, there's a little bit more value in fixed income or a little bit more value in equity. It's not taking you away from your target allocation, but it's just, playing on those edges. Again, we talked a lot about valuation and kind of a forward outlook. Like, I'm always of the school of thought, whether it's our service model where we want to under promise and over deliver, or even the investment side, right? Like, we're not trying to tell you something so that we can come in and look great. We're trying to tell you something so that we can plan accordingly. Like, so if markets don't do 17% a year like they did in the 90s, right, or they don't do 13% a year like they've done the last 10 years, but U.S. equities average half that, called 6%, or small caps are right around the same number. International stocks are a little bit better, we're okay. We're prepared for that, right? And so, I think it's safe to assume that the next 10 years probably won't be quite as good as the last 10. I think they're gonna be fun. I think, we're excited to be along for the ride. But, just if you're modeling out your, net worth for retirement or for legacy purposes, again, just use some more reasonable numbers here. Nice thing is on bonds and cash, right? This is looking at the last, call it 50 some odd years. Those U.S. bonds at 5.7 or cash at 3.6. I mean, those are spectacular versus where they've been the last 20 years, right? I do want to address what's on people's minds, right? Like, again, there's an element of these conversations when the market's gone up where it seems like it's a rah-rah session, or I've got rose-colored glasses on. There are, recessions, still on the front of everyone's mind. We obviously have wars in both Europe as well as the Middle East. Inflation hasn't gone away, right? So let me just hit on a couple of those real quick, right? So, the decline of globalization or just reordering, right? Like, I'm just not convinced globalization's dead. Like, you're going to have points of hostility. You're going to have countries that have nationalistic, moments, but like, it doesn't behoove you to not trade globally. Like, we're very lucky, our landmass, like, we've got rich natural resources. We've got, borders of oceans on our east and west. We've got a great neighbor up north in Canada. They mow your lawn while you're away. Mexico has a party here and there, but they're not that bad, right? So you think about like the good fortune we have, but we still want to do business in India. We still want to do business in China. We still want to do business in other parts of the globe. And I think everyone feels the same way, right? You'll see some instances where we're not all that inclined to trade with Russia today, obvious reasons, and I think that over time hopefully will dissipate. But the world is not necessarily still a unipolar, monopolar world, right? Where we just are so much ahead of everybody else. So you have this environment today where more multipolar. I would really think about the U.S. and China, and there'll be instances where there'll be some splintering off with Russia or Europe, where they seem like they have some clout in the shorter term, but again, it's really kind of a two-horse race. But again, globalization has historically been a source of improvement for humanity, so I don't think that's going to end anytime soon. Politics, right? We just saw the Iowa caucuses. Donald Trump won in a landslide. Ron DeSantis came in second. We'll get New Hampshire next week. By March, we'll know who the nominee is. Look, it's a repeat of 2020. We're definitely going to go ahead and have these same two folks, in the ballot box in November. But like, it's interesting if you look at your annualized return, right, for Democrats or Republicans going back really to the FDR days, right? It's not that different, right? Like, so well, let's not get too caught up in who's running the White House, right? What drives this country forward, and by and large, is what makes me excited to get up every day, is just corporations and their inherent ability to navigate a policy and political environment and motivated around profit, right? Hopefully, again, more often than not for the greater good. But the fact is, again, that's what we're investing. We're not investing in who shows up on January 20th for the inauguration next year. And this is again an important piece I would call out as well, right? Like, the idea is, you could look at this, environment. I like the bottom one. Republicans in office, when they have both the Congress as well as the White House, that's 11% of the time. So it's not all that often. The market does really well, 13%, right? When you got the Democrats, covering both Congress and the White House, also about 10%. That's a little bit more frequent. It's about 3 times as often as you see the Republicans. But most of the time, you have a divided government, 60% of the time. And equity returns are 8%, right? Like pretty good, right? Like you could say, well, 12.9 is greater than 7.9, or 9.9 is greater than 7.9. Fine, right? But me trying to predict what happens with inflation or interest rates or the stock market, my forecasting ability within the political environment, not just for call it 2024, but 2028 and thereafter, that's really difficult. We just talked about rolling investment periods, like 20 years. You're going to invest for 20 years, God willing, right? Hopefully, this, the earlier slide for Ibbotson, which had a 97-year data point, right? Maddie just gave birth a couple of weeks ago. Maybe Atlas has a 97-year time horizon. I do not, right? But the point being is, again, we're going to go through many election cycles. We're going to go through many recessions, bull markets, bear markets, so on and so forth. So let's not get too caught up in the noise of the next 9 months or so. Again, this is another one that's a big hot button, and I think it's important, right? Like look today, the government spends $2 billion on interest payments every single day. It was $1 billion before the pandemic. And so, there's a point in time when you have to start getting your house in order. So I would expect some improvement over time on the basis of government spending. I expect some improvement on revenue, which is higher taxes. But I'm not worried about the boogeyman, because, we talked about Japan a little bit in the discussion today. We as a central bank can ultimately absorb all of the creation of debt, right? Like if it gets to a point where like we just have to keep producing massive amounts of debt to pay off their debt, like the Fed can just buy all that paper, right, and keep interest rates low. It's more about an idea of getting in a place where we can agree that you can't just keep spending like a drunken sailor for the greater good in the long run, right? So again, I think those 3 points are worth paying attention to. I think they're noise. I don't think they're going to have a whole heck of a lot of impact on your portfolio in 2024 or even the next few years. But I just want to acknowledge them. I'm happy to have a conversation in more depth on any of those topics. Since we're running long here, let me take us home here. Again, we really do appreciate the time. Normally keep these an hour. The year-end recaps tend to be a little bit longer, but hopefully just the fact that it's an ugly day out there means you're not forfeiting a nice afternoon. But again, as I think about 2024, right? I do think we'll have a year which we'll see some return of volatility versus what we saw last year. But again, directionally, I welcome that. I think it's a good thing. The returns probably aren't going to be quite as good, right? I think you could say that for the equity markets, right? 26% would be great. I'd be happy to be wrong. You can rub my nose in it next January. I just think, again, that number is probably a little bit lofty. I do think the Fed probably cuts rates here, whether it's in March or May. We're splitting hairs, but I'm not of the school of thought that 6 rate cuts is in the cards. I was listening to a pretty good podcast a couple weeks ago. I forget who it was, but like, the Fed's either going to cut rates 1 or 2 times, or going to cut rates like 8 or 10 times, right? And on the 1 or 2 times is kind of, hey, let's just do this to check the box, but we want to make sure we don't end up, giving up some of the ground we've made up here, right? Like not having an Arthur Burns repeat of the 1970s. In the other situation, which is rates coming way down really fast, that's a recession, right? That's unemployment rates gone up. That's people losing jobs, and that's not something any of us want. Because I'm going to tell you right now, the stock prices are going to more than reflect that, right? Earnings, I do think they're going to grow this year. I have a hard time getting to 11% earnings growth. I think it's probably that high single digit number of 7, 8, 9. Hopefully, to the upside, more to the 9 versus 7. But again, 11 seems a little bit high. And I really do want to emphasize that we don't dislike the Magnificent Seven. We own them. We own them personally. We own them in our client portfolios. We just don't want to have too much of our exposure there, because if we do see a similar scenario to what we saw in 2022, where those markets draw down 20 or 30%, right? We just don't have the visibility into the future that we're going to continue to compound returns at 10, 20, 30, 40%, like we have in some of these instances. China is a huge question mark this year, right? I do think that like they have to come to some realization that their current economic policy isn't great, and whether they channel more stimulus to the consumer, where the with something like here's a stimulus check, you have to spend it within 60 days or you lose it, right? Or something that just looks to embrace their capital markets a little bit more so. But I think something's got to give. I do look forward to the days post Xi Jinping, which is another let's call it 4 years or so, because I do think we'll get back to some reformists. But for now, you deal with the cards you're dealt, and it's just not a great picture. Although again, things could improve the back half of this year. On the basis of fixed income, after the massive rally in the fourth quarter, right, we saw 10-year Treasury touch 508 on in October, came down to 380. We were pretty much at the end of the year. We're back around 402, 403. I think technically bonds are a little oversold, so we're looking to extend our duration out a little bit, but only when we get to see the 10-year on that 425, 450 territory. So we'll see. Again, the good news is I don't think rates are going to go from 4 to 6, or I don't think they're going from 4 to 2, but it's a little bit more nuanced there. And then again, last thing I'll say is, like, you got much better things to do with your time than watching, the political pundits, right, on the polling stuff. Show up on Tuesday in November and do your thing. But again, we'll be just fine with whoever's in the White House. So, folks, thanks so much again. We'll get this recording out to you. We don't normally anticipate spending 80 minutes with you, but we are grateful for it. And have a terrific Tuesday. Take care.